Hey everybody, my name is Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm covering disruptive tech investing for a broad audience of retail and institutional investors across the globe. Today we're going to talk about when you should sell a stock. And we put a title on here that says a bear market guide. And that's kind of what we want to talk about. Since the market seems to be correcting a lot, particularly in tech stocks, we wanted to talk about selling stocks and generally navigating bear markets. So this first bullet point is something that Warren Buffett said, and it's quite powerful. So it says the first rule of an investment is don't lose money. The second rule is not to forget the first. Now, what that statement assumes is that investors enter into a position with conviction, because you'll also hear another saying that gets tossed around quite a bit, which is always let your winners ride and sell your losers. Well, that's more about trading. So the worst reason actually to sell a stock is because the price dropped. And we mentioned in our UiPath video before that Jim Cramer had made a statement. I know he gets a lot of flack, but this one was particularly bad. It was about how he couldn't recommend UiPath anymore because the price of the stock had fallen so low, but it was an incredibly good company. And that's really difficult to see how somebody can talk like that, because if it's a really good company, and we believe UiPath is, then the lower that stock price drops, the happier you should be, because then you can buy shares cheaper. So today we want to talk about figuring out when to sell in a bear market, and it's actually a lot tougher to figure out when to sell in a bull market. So bear market's actually quite easy. And what you need to remember is that this old saying, the last bullet point, it's about time in the market, not timing the market. So when we invest, we're risk averse investors. We take a very long-term time horizon, ideally measured in decades. As Buffett says, the best holding period is forever. Now, certainly there are times when you should sell a stock, and we'll talk about that. Now, when you're young, you invest a lot differently and you spend differently. So they say that when you're young, you spend your money on fast cars, fast women, drugs, and alcohol, and the rest of it you waste. When you get older, you spend significantly less money, or let's say as a portion of your overall income, on these other things, and you become more concerned about losing money because you start to accumulate lots of it, right? So you need to start thinking about, all right, now that I have money and I'm saving it up, when am I going to need it? So the closer you get to retirement, the fewer risks that you want to take, the more you become concerned with capital preservation, as opposed to trying to find the next Tesla, which you see a lot of these FOMO, YOLO young investors on Reddit always focused on trying to find the best stock as opposed to trying to preserve their capital. Now, I wanted to talk a little bit about putting paper losses into perspective. So you can look at how the market's behaving today and how it's been behaving. The NASDAQ index QQQ, the ETF that tracks the NASDAQ index, down 21% year to date. Tech stocks have been taking an absolute drubbing. So I wanted to use this example. This is a chart for Invitae. And right now we're holding Invitae stock and we're down 80% on our position. Ooh, that sounds really bad, right? Well, we need to put this into perspective. So if you look at the chart here, you can see where that blue line is. So that's our average cost. That's our cost basis, around $25 a share. Today it sits around $5 a share, so that's about an 80% loss. Now, what's interesting is if you see that red line, if you bought at the very top, you'd be down 91%. So there's not a lot of difference there. At least that doesn't seem intuitive, right? It's quite interesting to note that. But here's what you can do and should do. Take the total amount of money you put in a position that you're down, like we're down in Invitae 80%. So take all the money that you put into that position, divide that by the total assets that you have under management, okay? And that tells you the amount of capital that you stand to lose, or at least it's a very good indicator. So we did that. We stand to lose less than 1% of our total capital. Well, when you start thinking about a position like that, it becomes a lot easier to see these paper losses and realize that, first of all, if you invested in quality companies to begin with, you shouldn't have anything to worry about. Again, going back to that statement, it's about time in the market, not timing the market. If you recall, in the dot bomb days, the entire tech market crashed. Big names like Oracle and Intel fell 80%. And it took 10 years for them to recover. Now, going back to our earlier comment about when you need your money, you need to be able to have time in the market. So as you start to approach retirement, investing in tech probably becomes a lot less appealing. And one way that you can diversify away risk is by taking a look at your asset class allocation. So take a step back and say, where are all my assets invested? And this is our current asset class allocation. I just refreshed the numbers and it's somewhat interesting. So the majority of our capital is in a strategy that myself and Peter Vito, he's our head of research, we built this strategy working at one of the leading financial institutions around, and they're actually a leader in risk management. So that's what we had our work experience in, building and selling and maintaining risk management tools. So we know a lot about risk. And this same firm is the global leader in indices. So we know a lot about indices. So we created Quantigence, which is a index of sorts that tracks dividend growth investing stocks. It's really cool. We spent a lot of time developing it. It's where the majority of our money is in, and it works really well. And you can go to quantigence.com. That's a side project. We're going to be eventually building that out. But you can see here that this is our allocations. We have Quantigence at 56%. Nanalyze our tech portfolio, 38 tech stocks. I think it's 36 now, 14%. That's dropped quite a bit. And we have these bits on the right. Now, if you look at the assets that we have the most money in, I thought that would be interesting. What single assets are we holding the most money in right now? These are the names on the left. You've got Johnson & Johnson. If there was one stock that you're going to own, that's probably it, if you had to own just one stock. Then we've got Archer Daniels Midland. Clearly, they're doing well because of the commodity boom. You've got automatic data processing. Not sure why they're doing so well, but that's the great thing about a dividend growth portfolio. It's set it and forget it. And then you have ExxonMobil, which is clearly doing well because of the price of oil. Now, if you look at these names, all these companies, arguably perhaps not ExxonMobil, will be around when, let's say, the average person dies. These companies are still going to be around. So anybody that's on this call, you can be pretty sure that these companies are going to survive for quite a while. So taking a look at asset class allocation, now you can see why that Invitae position is actually, even though it's horrible to look at that paper loss, and it's just a paper loss, it's not even actual loss of money. It's horrible to look at a paper loss, but always put it in context as to how much that paper loss represents your assets. Now, let's talk about when to sell stocks. Dividend growth investing is very simple. Sell when the dividend stops growing. End of story, period. We recently swapped out AT&T with Nordson. AT&T stopped raising their dividend. Done. Kicked out the door. Nordson took their place. Now, when it comes to tech stocks, there's 3 reasons why you would sell. When your thesis changes, all right, and the thesis is not the share price dropping, it's your thesis that you enter the position in that you hold with conviction. That's 1. 2, when revenue growth stops, that's fairly easy to monitor, but quite subjective. So how many years do you give them? 2, the Rona was a good example of where somebody would say, well, the Rona, and then the next year revenue's not growing. Well, how many years do you give them? And then, of course, when an M&A event forces you to sell, all right? And then there's the bull only rule, which says when a portfolio rule is triggered, you sell. So for example, we have a 10% rule in our portfolio. Last year alone, we covered our NVIDIA cost basis 7 times over simply by trimming that position. And all that money is why part of the reason why we have cash and dry powder now to take advantage of falling stocks, quality companies. All right. Now, one example of a company where our thesis changed was Berkeley Lights. And when that short report came out, we took a look at it, probably ignored 90% of it, but there were some critically important facts in there. And I think this was Scorpion Capital, and they recently published a piece on IonQ, which I haven't read yet, but I can probably tell you that they have some concerns around the lack of revenues and related party revenues. That's a given, that's in their report. They also put one out about Ginkgo Bioworks. So when you look at these reports, you need to just see them for what they are. It's a short seller going after a firm, but there's usually some interesting tidbits. We found enough tidbits in that report to where our thesis changed. And after we sold shares, that blue line is about where we sold. Whether or not that was the correct thing to do, hard to say. But what ended up happening is that the company didn't hit their revenue guidance, which is one of the key reasons why we sold, and their CEO exited. So clearly there's some turmoil in that company, and getting out of it, in our mind, is the right thing to do. And we don't look back. We made that decision. It's over with. So in terms of a post-mortem, you should always reflect on that. There were a number of bits here. I think that we didn't sufficiently understand their tech. Not that we understand any high-tech firm extremely well, but this statement kind of sums it up. And I think we just threw it in our portfolio when we were trying to put together our portfolio for paying subscribers. And we said here the company uses lights to sort cells using semiconductor technology. That's about the extent to which we understand their tech. Okay, it's not sufficient there. We didn't identify customer concentration risk and monitor that. That's very important. And we paid far too high a valuation for shares, and we've since corrected that by introducing our simple valuation ratio. Now, going back to the importance of quality companies, and this is really something that you would have already had to have been doing. So you may be holding companies that aren't quality and you may have some concerns, but if you're holding quality companies, they'll survive downturns. There's intrinsic value there. Larger companies always fare better. That's why we have a market cap cutoff at $1 billion. We never invest pre-revenue. That's a critically important rule. And we get flack on that all the time. People coming around, well, you would have missed Tesla. Actually, no. When Tesla had their IPO, Tesla had 116 million in revenues and 111 million the year before. I believe that was 2009. And that isn't true. I can't tell you how many duds we've avoided by having this rule. You don't invest pre-revenue, because by the time a company goes to public markets, they need to have shown traction. If they weren't able to do that when they had VC funding, when they go to the public markets, it's usually not a matter of funding. It's usually a matter of not having product market fit. So these are extremely important rules. You talk about how to navigate a bear market. Is make sure that you're holding quality companies. Now, just lastly, on going back to Invitae, some lessons learned. So, tomorrow we could lower our cost basis from 80% to 40% by investing another 0.75% of our capital and feel really good about ourselves. We don't have to look at that ugly number, but we don't do that. When we invest in a stock, we set a maximum amount of capital for any stock. We don't invest past that. That's a rule that we set. So setting rules and following them and not making exceptions is very useful. Invitae isn't the only stock we've ever been this deep in the red on. Certainly won't be the last. Now, our simple valuation ratio we put in place, going back to the BLI example, that perhaps our cutoff of 40, arbitrary number, but it's important you have one, perhaps that could have been too rich. So I talked to other subscribers who use values of 30 or 20. They've fared a lot better because they've bought in a lot cheaper. So we certainly overpaid for Invitae. Looking at going back, and Ark talked about backing up the truck on the mid-teens. Did we give too much credibility to that? Were we paying attention to that? And it goes back to what we tell everybody else: don't try to ape an active manager. All right. And just to touch on Ark, so do you notice this? It was St. Kathy until it wasn't, right? And all of a sudden everybody's slinging mud at Ark. They can't sling enough mud. Ark loves risk like a fat kid loves cake. Risk is volatility. Volatility goes both ways. It should be no surprise at all. It should be expected that Ark is underwater, deep underwater on some of their positions. They take a lot of risk. So the only reason you should fear paper losses, the only reason Ark should fear paper losses, is if they didn't invest in a quality company to begin with. Going back to our point about not investing pre-revenue, not investing in small firms, that will work out very well in a bear market. So please go ahead and put your comments in the comments section. We'll address them there. Make sure to subscribe to our channel. Thanks so much for taking the time to watch this video today.